Welcome back to Home Buyers Money Map, your guide to financial clarity in BC's real estate. So today we are tackling a fundamental question or decision that people have when it comes to kind of like affording your monthly payment and everything. And your mortgage type is kind of important when you don't really know what different types and how it could affect you. So for that, we have Damon here to kind of tell you which one might be the right one for you. So Damon from Pilot Mortgage Group. All right, Damon, let's just dive into it. So different mortgage types and different terms. Yep. Explain it to us.
Great, yeah. So usually you'll hear two terms for the most part. And there's a lot of different mortgage products and a lot of different types of ways in which they work. But basically the big piece or the big picture is you have fixed mortgage rates and you have variable rate mortgages. Sometimes they're called adjustable rate mortgages. And the key difference between the two is a fixed mortgage rate is a flat rate that stays with you for the entire duration of the term of the mortgage. So if you signed up for a 5-year term and your rate's 4.3%, that rate, even though the economy might be going up and down, your 4.3% remains static the entire duration of your term, right? Which is good because it's like you have the certainty of knowing your payments aren't going to change, your interest costs aren't going to change, they remain flat and fixed over that duration of time. Variable rate mortgages, those are ones that are more flexible. They flow, they adjust based on kind of economic activity. So if inflation is going up, there's a lot of prosperity, interest rates or variable interest rates may go up with that in order to try and lessen, the inflation in the economy. If the market is not doing so great and we're going through a deflationary cycle, in order for the government to get people to start borrowing more money and start investing and start spending it, they'll lower interest rates, which if you're a variable rate mortgage holder is music to your ears because your payments are coming down, your interest costs are going down. So that's like the main difference between those two types. And you might think to yourself, well, this kind of seems like a no-brainer. Why wouldn't everyone just take a fixed mortgage rate? You've got this guaranteed interest rate. Like if all things are considered equal, why wouldn't I just take the one that's guaranteed? I don't want to, sure, maybe rates come down in the future, but I'd like the certainty now. The interest rate that you pay for a fixed mortgage rate with a lender is typically higher. It usually starts off higher. You pay a bit of a premium for a fixed mortgage rate for that certainty over that duration of time. So that's why you might see people decide, start to ask themselves whether or not they might want to pay that extra premium for a fixed mortgage rate. There's other advantages to a variable rate mortgage, for example, where the penalty, if you needed to get out of the mortgage at any point in time during the course of the term, is typically lower with variable rate mortgages. So if, let's say, for instance, I have a client that's trying to decide which rates to pick, some of the questions that I'll ask them will be like, what's your anxiety levels, right? Is this something that if the idea of an interest rate going up and your payments increasing by X amount is something that's going to keep you up at night, let me know now, because maybe a variable rate's a bad fit for you. Or, hey, what are you likely going to be doing with this property in the next 2 to 3 years? Sometimes people are like, I don't know, I immigrated here from another country. I'm happy to live here for now, but my job might take me anywhere, right? So I might have to sell at some point. And so a variable rate might be a really good fit for that person to try and lower those costs that they may have to pay if they have to get out.
Yeah, and I definitely feel like just looking at the number, the rate itself, is not the only thing that people should consider for sure. For example, I have a friend who actually asked me about, I think this was 2022 when the pandemic, the interest rate was at the lowest. We were both kind of renewing our mortgage, and then he's like, oh, the variable interest rate is super low. And I said, well, if once we get out of this pandemic, I was just telling him that it's likely interest rate, actually it's probably guaranteed interest rate will go up, and just how fast and how much. And then, but he's like, oh, but I did the calculation. I think this will be a good idea. Meanwhile, I took fixed rate, which was still actually quite low at the time. And then a year or so later, Bank of Canada started to increase rate. So every time they announce rate increase, he's like, oh, it's going up again. And then we heard this in the news as well, right? So it's not just about it. the number basically. You do have to consider kind of like the market condition, whether or not you anticipate what is kind of like upcoming in terms of the world, so you understand whether or not the rate will go up or maybe it's going to go hold steady and things like that. And another story is of my mother. Like she does not like risk, not at all. So back in the day when we had mortgage, what she did was that she also doesn't want to be locked in too long because she understands, the premium is higher, right? So if you fix it for longer, you're paying more interest. So she would do like every year she would go for a fix. Every year she would go for a fix, or every 2 years she would go for a fix until everything was paid off. There are different ways to kind of structure the terms and just how you want to go about it. And what about amortization?
Yeah. Okay, so amortization, it's a big word, and it describes the amount of time that you have to pay off your mortgage in full. So sometimes people might mistake the word term for amortization. Term is the length of time that you're in a contract with your lender, right? So you've agreed to, like, I'm going to be with, this bank for a 5-year period at this rate. That's the term. Amortization, completely different than that. It's if it's spread out, let's say over a 25-year amortization, your payments will be X based on your rate. So amortization is not, if someone says like, oh, I have a 25-year amortization or 30-year amortization, that doesn't mean that they're locked into an interest rate or specifically with that lender for that duration of time. Now, this is one thing if you're looking at like mortgage videos that might come from the US, there are terms, because it's a huge market, a lot of people take terms that are like 25, even 30 years. Like that's where they like have a guaranteed interest rate for a very extensive period of time. We don't really see that here. Typically, the average term length that most people are taking is anywhere from a 3 to a 5-year term. There are 10-year terms at the longest, but nothing beyond that.
Have you seen people actually lock into 10 years?
We have not really seen that. You pay such a significant premium for locking into 10 years. Maybe if you had qualified for it back in 2022 before interest rates started to really pick up, may have been to your benefit, but like the cost difference between the two, like in 2021, 2022, you might have been able to get a 5-year fixed rate at like 2%, even like less than 2%, 1.75%, whereas a 10-year rate at that time may have been 4%, which is a really tough, like, do I really think that interest rates are going to go up so dramatically to where that would be to my benefit?
Yeah, but if you, because I was looking at around that time too, so it was like 4%, 5% if you lock into a 10-year rate. And I'm like, but even if inflation goes up and the interest rate goes up, is it actually going to go up to that? And it proves that it kind of went close to that, around that. For some people it might be a little bit beyond that, but then is it worth to kind of be paying more all these years? Because like also beyond 5 years, it's really, really hard to predict where the market's going to be at, where the economy is going to be at. Yeah, for sure. What about sort of like penalties and whatnot?
Yeah, so penalties, this is just the nature of mortgage terms. The bank is committing to you that they're going to lend you this money. They're expecting you to commit to them to stay with them for whatever period of time. And if you need to get out of that commitment, they're going to penalize you for it. So what a lender will charge is different from one to the next. So that's one of the most important things that we need to cover with clients is that you need to be prepared for if you need to get out of this. So first of all, we want to make sure that if they are saying imminently I'm going to be selling my home in the next 2 or 3 years, we want to make sure that we know that either their mortgage has been renewed at that time or their penalties are going to be low and it makes sense for them to lock in for that. So we want to make sure that we factor that in. But life happens, right? People don't necessarily live in their home forever. They have to move or relocate for work. Maybe they have a separation from their spouse. Just things happen, right? And so you might get hit with a penalty because you're like, I need to sell my property now. So making sure that you're with a lender that's going to give you a penalty that's, at the end of the day, when you do end up selling your property, it's not such a significant sum. And it will fluctuate. right? So that's an important element in this as well, is that your penalty can change from what it would have been if when you started to what it will be when you sell. So you want to be also cognizant of how much could your penalty become in the event you were to sell and interest rates go up or down.
And then the other thing is, when it comes to, you can always negotiate with your lender to see if you're buying a next property, you might be able to port it or things like that, right?
Absolutely, yeah. So a lot of people will actually choose to do that, right? They're like, I've got 2 more years left. I got an amazing interest rate with my bank. I'm going to port my mortgage over. The problem is that you have to qualify for that. So if for whatever reason the lender doesn't accept your income, or they don't like the next property you're buying, or there's some attribute of your file that's going to prevent them from qualifying you, even though you've got this amazing rate and you're able to avoid your penalty, if they won't qualify it, you can't port your mortgage. So it's important, before you make any decisions, before you jump into anything, selling your home, buying another property, you have that discussion with your broker or your bank so that you can make sure that you can port that mortgage over without any stress or pain.
All right, that's really great advice, and it's an incredible feat to just kind of purchase this home. So we want to make sure you're happy and you enjoy your home after your purchase. So the takeaway today is that you must understand your own risk tolerance and basically have a trusted broker to help you kind of navigate through that and understand the different terms, and then perhaps fixed rate might be better for you, or variable rate might be right for you at the moment. So, because the life changes, like we said, right? And contact Damon at Pilot Mortgage Group if you have any home financing needs. So in our next episode, we are going to talk about some of the forgotten costs, and let's talk about costs that comes with home purchase. And so thank you for tuning in. If you have any questions or if you have any comments, leave in the just comment section, so give us some feedback. And you can contact Damon for any of your home financing needs, and follow me if you don't want to miss out on the next episode. Until then, have a good one.